You could be sitting in a coffee shop in, I don't know, Bangalore or Lagos or London right now, and in the time it takes you to finish your latte, you can literally spin up a U.S. Delaware corporation.
Yeah, you become a multinational CEO before your coffee even gets cold.
Exactly. And a few days later, you've got a U.S. bank account, you're signing these global software contracts, and I mean, it feels entirely like magic.
Right, but the catch is that exact same magic trick can saddle you with, well, a $360,000 fine before you've even made a single dollar of profit.
It's terrifying. And that invisible cliff you just mentioned is exactly what we're uncovering today. So welcome to the deep dive. Our mission today, for you listening, is to really map out the hidden, almost invisible architecture of global business operations.
It's a structure everyone is participating in, but almost nobody actually sees.
Right. And we are anchoring this conversation on a really brilliant 2026 white paper published by Merze.ai. It's titled The Cross-Border U.S. Tax Compliance Playbook. And look, I know tax compliance sounds like a topic engineer to put you to sleep,
It really does.
but stick around because the financial stakes and just the sheer chaos we're about to discuss are absolutely wild.
They really are because, I mean, we aren't just talking about remembering to file some boring paperwork by April 15th.
Yeah.
We are looking at a living, breathing system where a single, seemingly harmless administrative shortcut can literally kill a company's funding round. Or worse, just bankrupt the founders entirely.
The stakes are that high.
Oh, absolutely. The entire premise of our deep dive today is summed up perfectly by this one line from the playbook. It says, every cross-border startup is one broken workflow away from liability.
Wow. One broken workflow. And it's not some rare edge case problem either. The playbook highlights this massive glaring statistic. They found that 80% of businesses at cross-border complexity actively limits their market expansion.
Right, which is huge.
Think about that. 4 out of 5 businesses are looking at the global market and just deciding, you know what, it is simply too dangerous to step out there.
And honestly, that fear is entirely justified. Because the way most founders think about compliance is fundamentally flawed from day one.
How so?
Well, they think of it as a series of isolated chores, right? Rather than this tightly interconnected ecosystem.
Okay, let's unpack this, because this is where we have to completely change the paradigm for anyone listening. Most founders treat compliance like a grocery list.
Yeah, exactly.
You check off, incorporate the business, done. Open a bank account, done. Hire a dev, done. But the reality they point out in the source is that a global business is actually a tightly coupled living system.
Yes.
It's made of 4 interdependent nodes: payments, tax, entity, and reporting. So if the grocery list is the myth, the reality is more like a Jenga tower.
That is the perfect analogy.
Right. You blindly pull one piece at the bottom and the entire structure just collapses on your head.
It does, because in a tightly coupled system like that Jenga tower, weakness in one single node automatically creates intense pressure on all the others. And this fundamentally changes how a founder needs to view their business operations. You can't just hand a shoebox of receipts and software subscriptions to an accountant at the end of the year and assume you're safe.
Because it's too late.
Exactly. By the time the year ends, the structural damage to your Jenga tower might already be completely irreversible.
So let's follow the money here and look at the first 2 nodes in this system: payments and tax. The playbook notes that setting up a payment gateway is usually a founder's very first touch point with global operations.
Yep, day one stuff.
But it's also the exact place where invisible liability starts piling up in the background.
Yes, and it almost always happens innocently enough. So imagine a scrappy founder, let's call her Sarah, based in Toronto.
Yeah.
She is waiting for her Delaware corporate entity to be fully formed, but she has this eager customer in the U.S. ready to pay for her software right now.
Which is great. You want that revenue.
Of course you do. So to keep the momentum going, she just routes that early revenue through a personal bank account or maybe a temporary third-party processor.
Right, just to get the cash in the door.
Exactly. It seems like a classic get-things-done startup move. But what she has actually done is create a permanent paper trail that tax authorities in 2 different jurisdictions are going to heavily scrutinize later.
Oh, man.
She is instantly creating retroactive tax exposure in the country receiving those funds.
And here is where the playbook brings up a terrifying new reality. The penalties for those kinds of payment routing mistakes aren't just a slap on the wrist anymore.
No, not at all.
If you are listening to this right now and you process payments that involve any user data, you need to pay close attention to the 2024 Department of Justice final rules on cross-border data flows.
This was such a massive shift in the landscape. The DOJ basically said, hey, if you are moving money, you are usually also moving data.
Exactly. When you process a payment through a modern gateway, you aren't just sending dollars. You are transmitting bulk-sensitive personal data, like IP addresses, geolocation, user metadata,
All this.
and if you accidentally route those payments, and by extension all that bulk data, to what the U.S. designates as countries of concern, you are stepping into a massive minefield under the International Emergency Economic Powers Act.
The penalties there are just staggering.
We are talking about fines of up to 368,136 muddles per violation, or double the transaction value, whichever is higher.
What's fascinating here is how quickly a mistake in that first node, payments, bleeds directly into the second node, which is tax.
Right.
Most founders don't even realize they've made a payment layer mistake until it triggers a massive tax crisis down the line. And according to the data in the white paper, that tax crisis usually surfaces 18 to 36 months after the triggering event.
Wow, that long.
Yeah. That delay is what makes it so lethal. You think you got away with it, you think everything is completely fine, but the time bomb is just quietly ticking in the background.
But wait, I have to push back here for a second. How is a global startup supposed to grow if they can't even operate internationally? I mean, you want to hire the best talent, right? If the absolute best engineer for your product is in Berlin or Tokyo, you hire them. Are you saying you can't do that without triggering a tax nightmare?
You absolutely can hire them, but you really have to understand the mechanism of what tax authorities call permanent establishment risk,
Okay.
or PE.
Okay, permanent establishment.
It is deceptively, almost comically simple to trigger. If you hire that single full-time employee in Germany, or honestly, even if you just store some physical inventory in a third-party foreign warehouse to speed up local shipping,
Wait, really? Just a warehouse?
just a warehouse, the local tax authority can legally argue that you have created a taxable corporate presence in their country.
So you don't even need to open an official German branch or like a formal subsidiary.
Exactly. You don't need an office with a logo on the door. The activity itself creates the presence. And once you are classified as a permanent establishment, congratulations, your entire startup now owes local corporate taxes on revenue generated there.
That is brutal.
You also face local filing duties, and you're subject to deep, multi-year local audits. It's like accidentally putting down roots and buying the land when you really just meant to pitch a tent for the night. That's a great way to put it. And then there's the indirect tax side. We have to talk about the EU VAT one-stop shop regime. For a software as a service company, if your cross-border sales into the EU exceed just 10,000 euros,
Which is nothing.
it is basically nothing for a growing startup. But once you hit that, registration becomes absolutely mandatory.
Right, and the mechanism of failure there is so brutal. Let's say you cross that 10,000 euro threshold in March, but you don't realize it, so you don't register.
Okay.
Every single invoice you issue to your European customers in the interim might be invalidated retroactively.
Wait, why?
Because without a valid VAT ID on the invoice, your corporate customers can't claim back the VAT on their end, so they dispute the invoice and they just refuse to pay.
Oh, wow.
Suddenly, this reliable revenue you thought was locked in is completely evaporating. And we also have to talk about transfer pricing here. The playbook explicitly calls transfer pricing the single most audited area for multinational startups.
Yes.
Now, wait a minute. Transfer pricing sounds like something only Apple or Google has to worry about when they're, stashing intellectual property in Ireland. Why is the IRS auditing a 10-person startup over this?
It's a really great question, and it's a huge blind spot for founders. Simply put, transfer pricing is just the pricing of transactions between related entities within your own company.
Okay.
Say your U.S. parent company pays your own subsidiary in India for software development. You cannot just invent a low arbitrary price to shift your profits out of the U.S. and into a lower tax country.
Ah, I see.
The OECD has this international arm's length standard, which dictates that the internal price you pay your own subsidiary must exactly match what you would pay an unrelated independent third party.
So the profit has to align with where the economic value is actually created. So if my U.S. company pays my Indian subsidiary like $10 an hour for code that an open market agency would charge $50 an hour for, the IRS flags it.
You got it. Because you are artificially keeping the profit in the U.S. or vice versa. If you mess up that internal pricing, the tax authorities will forcefully recalculate your taxes for you, and they attach incredibly heavy penalties for the discrepancy.
And small startups get caught because they just assume they can move money between their own bank accounts freely.
Exactly. They think it's all one pot of money. It isn't.
Okay, so that's the operational side, moving money and paying taxes. Let's pivot to the structural side, your entity and your reporting requirements, because this is where we get into what I like to call ghost liabilities.
Ghost liabilities, I like that.
Right, it's how simply existing can cost you everything, even if you make zero money.
Well, your entity is the legal container holding your entire business. And if that container is shaped wrong, everything spills out. The most common structural failure mode identified in the source is the foreign-owned U.S. LLC.
Yes. Let's walk through exactly how this traps people. A founder living overseas sets up an LLC in Delaware because, well, they read online that it's the gold standard for startups.
Sure, everyone does it.
But the U.S. IRS looks at that LLC and often treats it as a disregarded entity, meaning the LLC itself doesn't pay corporate taxes. Instead, the tax obligation passes straight through to the human owners.
Right. From the U.S. perspective, it's just a pass-through.
But the founder's home country, let's say they live in the UK, might look at that exact same Delaware LLC and say, nope, under our laws, we consider that a regular, opaque corporate entity.
And that is where the trap snaps shut.
Exactly. So what happens? The U.S. IRS taxes the founder personally on the business income. But when the founder transfers that money to their UK account, the UK government says, you are taking a corporate dividend from an American company. We are taxing that too. Because the two countries categorize the legal container differently, the founder ends up getting hit with brutal double taxation on the exact same global income.
Yeah.
They're literally trapped between two conflicting rule books.
And that leads us perfectly into the final node of the ecosystem, which is reporting. Because even if you aren't making a single dime, even if you are just existing as a disregarded entity while you build your product, you are still on the hook.
Here's where it gets really interesting. I was reading this section of the playbook, and I realized that reporting penalties in global business are essentially like getting a $25,000 parking ticket for a car you haven't even driven yet.
That is painfully accurate, because reporting obligations are triggered by existence, not by commercial activity. Let's look at IRS Form 5472.
Okay.
If you have that foreign-owned, disregarded entity we just talked about, you must file this form every single year, period.
Even with no revenue.
Even if you had zero transactions, even if the business is completely dormant and hasn't launched yet. If you miss that filing, the IRS hits you with an automatic $25,000 penalty per form, per year.
Wait, hold on. I just want to make sure I'm hearing this right.
Yeah.
You make absolutely $0, you conduct zero business, and you owe the U.S. government $25,000 just for forgetting to tell them that you made $0.
That is exactly right, because the penalty is for failing to report the structure, not failing to pay taxes. And then there's the FBAR requirement, the foreign bank account report. You have to disclose foreign bank accounts to the U.S. government if the balance exceeds $10,000. But the catch here is that it's not based on your year-end balance.
Let me guess. It's any time.
Yes. It's triggered if the balance exceeds $10,000 at any single point during the calendar year.
So if I hold $11,000 in a foreign account for just 24 hours to cover, like a big payroll run, and then it immediately drops back down to zero.
You've crossed the threshold, you triggered the reporting requirement for the entire year, and if you don't file, the penalties are notoriously aggressive.
So we have these four interconnected pieces now: payments, tax, entity, and reporting. Now that we see the whole board, let's look at what happens when a player makes a bad move. Because earlier, we talked about the Jenga tower. What does it actually look like when the tower falls?
If we connect this to the bigger picture, we see what the experts in the paper call the cascade effect. This is really the core thesis of the entire playbook. Failures in global business do not occur in isolation. They propagate.
One knocks over the next.
Exactly. One broken workflow bleeds into the next, and it just compounds.
Let's trace a detailed hypothetical scenario from the playbook to make this concrete. Say you get your foreign exchange or your FX routing wrong. You price your software in euros, but you improperly route it to a USD account using a vendor that classifies the transaction as a cross-border royalty payment instead of standard software revenue.
Okay, a simple misclassification.
Right. And because of that improper classification, you fail to withhold the required tax at the source.
Exactly. So your payment error just became a tax error.
Right. And because you underpaid your withholding tax, the local tax authority flags your account They initiate a review of your operations. And during that review, the auditor realizes you've been using a local warehouse and hiring local contractors,
Oh, yeah.
meaning you've been operating a permanent establishment without registering. The ultimate result: you are hit with massive back taxes and penalties in 2 to 3 different jurisdictions, all stemming from a single, poorly configured payment routing drop-down menu on day one.
Or let's look at the real-world EU VAT example we touched on earlier. You miss your €10,000 VAT registration trigger.
Yeah.
Your invoices are retroactively voided by your corporate customers. Suddenly, you have a massive chunk of unrecognized, disputed revenue on your books. And when does that revenue gap usually surface?
Probably at the worst possible time.
Exactly. It almost always surfaces right in the middle of investor due diligence when you're desperately trying to raise capital.
And the playbook highlights 2 specific, devastating real cases of this that surface in data rooms every day. In one case, a software startup literally had to accept a 15% reduction in their total company valuation during fundraising.
Which is millions of dollars.
Millions. Why? Because the investors found unresolved VAT exposure, got spooked, and just priced the risk directly into the deal. And in another case, a fintech founder lost 6 crucial months on a Series B round simply because their intercompany contracts, that transfer pricing documentation we discussed, were incomplete.
And that highlights arguably the most crucial point in all of this. The fines themselves, as terrifying as they are not actually the worst part of a compliance failure.
They aren't.
No, the real killer is the operational paralysis. Losing 6 months of momentum when you are trying to close a Series B can be entirely fatal for a fast-growing startup. The cascade effect paralyzes your ability to operate, it freezes your ability to raise money, and it kills your growth.
It really is a compounding nightmare. And what's super sobering for anyone listening right now is that the rules of the game are getting significantly stricter.
Oh, absolutely.
The playbook outlines a few massive regulatory vectors between 2024 and 2025 that are turning this landscape into just an accelerating minefield. We already walked through the U.S. data, cross-border restrictions from the DOJ, but there's also extreme, unprecedented volatility in trade and tariffs right now.
Right.
In fiscal year 2025 alone, U.S. Customs and Border Protection issued 2,218 trade penalties and collected over $216 billion in duties, taxes, and fees. $216 billion.
That is a staggering amount of enforcement.
If you are a product-based startup importing goods, getting your tariff classification wrong carries enforcement risk on a scale that simply didn't exist 3 years ago.
And this raises an incredibly important question. How do these new regulations apply to digital products, particularly artificial intelligence?
Yes, the AI angle is huge here.
The playbook points directly to the EU AI Act, which reaches full enforcement in August of 2026. This act is critical because it has extraterritorial reach.
Meaning it applies no matter where you live.
Exactly. It absolutely does not matter if your company is incorporated in Delaware or Singapore or Dubai. If your AI systems are sold or even used within the borders of the EU, you must comply. And the penalties are astronomical. We're talking up to 35 million euros or 7% of your global annual revenue, whichever is higher.
And the mechanism for failure there is so subtle. The playbook cites a Gartner prediction that they say by 2027, over 40% of AI-related privacy violations will stem from unintended cross-border data exposure via generative AI tools.
It's so easy to do.
Think about how easily that happens. Your employee in Chicago is using a cloud-based AI tool. They paste a spreadsheet of user data into a prompt, just to get a quick summary, and suddenly, without anyone realizing it, sensitive personal data has crossed a border, violated the EU AI Act, and triggered the DOJ's data rules all simultaneously.
It's a perfect storm of invisible liability. The technology is simply moving way faster than the founder's ability to map the compliance implications.
So what does this all mean for you, the listener? How do we actually fix it? If the traditional, hand a shoebox of receipts to a lawyer at the end of the year method is completely dead, how does a founder build a modern company without stepping on a landmine?
Well, the playbook outlines a highly specific blueprint, and the core message is this. You do not need more expensive lawyers. What you need is systems thinking.
Okay.
You have to build the compliance architecture before you build the business infrastructure.
Right. And they give very concrete steps for this. First, establish ownership before crossing borders. Before you operate in a new country, someone specific on your team has to own the payments process, the tax process, the entity structure, and the reporting requirements.
Exactly. Second, you must treat intercompany agreements as core operational infrastructure. Those transfer pricing documents and IP licensing terms, they aren't just bureaucratic paperwork.
Right.
They are the factual legal record that tax authorities and your future investors are going to judge your entire business on.
Third, and this goes right back to our ghost liabilities, you have to build a reporting cadence from day one. You do this by mapping regulatory triggers to business milestones.
Yes, mapping the triggers is key.
If you hire your first employee abroad, that action is a hard trigger to run a permanent establishment assessment. If your dashboard shows you crossed 10,000 euros in EU fails, that is an immediate trigger to register for VAT.
Exactly.
If you open a foreign bank account to run payroll and it spikes over $10,000 for a single day, that is your trigger to file an FBAR. These aren't random surprises from the government. They're entirely predictable if you just map the system.
Predictable is the perfect word. And finally, you have to audit this interconnected system quarterly, not annually.
Because it moves too fast.
Right. As we've discussed, these pieces are highly interdependent. A seemingly small change in your payment routing gateway in March alters your tax liability, which ultimately alters your reporting requirements. If you wait until December to check on it, the cascade has already happened and the damage is done. Ultimately, the greatest takeaway here is understanding the sheer return on investment of prevention.
It's so much cheaper.
It really is. The playbook lays it out starkly. Prevention is 10 to 100 times cheaper than remediation. Doing it right at the beginning takes a few weeks of planning and maybe hundreds of dollars. Trying to catch up after the cascade has triggered.
That's when it costs you.
That costs months of operational paralysis and 6 figures in penalties and legal fees. It is literally the difference between building your Jenga tower on a solid table versus building it on a wobbly chair.
That's so true.
Knowledge is most valuable when it is understood and applied. For you listening, mastering this architecture isn't just about avoiding fines. It is the ultimate competitive advantage in a globalized world. Because while your competitors are paralyzed in due diligence, your foundation is absolutely secure.
That is exactly it. A secure foundation is everything.
Yeah.
Thank you all for joining us on this deep dive. To synthesize what we've unpacked today, global business is not a simple checklist. It is a fragile, tightly interconnected ecosystem of payments, tax, entity, and reporting.
Absolutely.
But I want to leave you with one final thought to mull over. We talked earlier about how generative AI tools are accidentally leaking data across borders and triggering massive 35 million euro fines under the new EU AI Act.
Right.
As companies increasingly hand over actual autonomous operational control to AI agents, literally letting AI negotiate vendor contracts, route international payments, and manage global supply chains, who is making sure those AI agents understand the intricacies of international tax compliance? Could your company's AI accidentally open a foreign warehouse to optimize shipping speeds and completely invisibly trigger a permanent establishment crisis while you sleep? The Jenga tower is getting taller, the game is moving faster, and soon you might not even be the one pulling the pieces. Something to think about. Until next time.